This is the story of why central banks are abandoning the dollar, and why they re-running toward gold, as if time is running out. To understand why the guardians of the global financial system are turning against the US dollar, we need to step back, far back, because the real story didn't begin this year, or in the last decade. It began nearly 80 years ago, in the ashes of World War I. In 1944, at a peaceful resort in Bretton Woods, New Hampshire, delegates from 44 nations gathered to rebuild the world economy. Out of this meeting came a bold new financial order. The US dollar would become the center of everything, backed by the largest gold reserves on Earth. Back then, America controlled an astonishing share of global gold. Nearly 2/3 of all above-ground reserves sat in US vaults. This made the dollar not just a currency but a promise, a claim check for gold. Even as the world anchored itself to the dollar, the seeds of its future crisis were already quietly growing. Countries trusted the dollar because it was backed by gold. America promised that any foreign government could trade its dollars for a fixed amount of gold, $35 per ounce. But by the 1960s, the world was drowning in dollars. Europe had recovered, global trade exploded, and the United States kept printing money to fund wars, social programs, and overseas commitments. Foreign nations started doing the math. If everyone tried to redeem their dollars for gold, the United States simply didn't have enough to honor its promise. On August 15, 1971, President Richard Nixon went on television and stunned the world. He ended the dollar's convertibility to gold. Overnight, the global financial system shifted from gold-backed money to trust-based money. The dollar survived. It even grew stronger. But it was now backed by nothing except economic power and global confidence. To stabilize the new system, the United States formed a financial pact with Saudi Arabia. In exchange for security guarantees, Saudi Arabia would sell oil exclusively in US dollars. Other nations followed. Oil, the lifeblood of modern civilization, became priced in one single currency. And this gave the US unprecedented power. Countries needed dollars to buy energy. This petrodollar system created artificial demand for the US currency, reinforcing its global supremacy. But strength always creates vulnerability. When one currency becomes unavoidable, everyone must hold it, borrow it, and transact with it, even nations that don't like each other. Even nations that don't trust the US, and when you rely on something you don't control, you always looking for an escape. The first cracks. 1990s 2008. By the 1990s, the US dollar had become more powerful than ever. Wall Street dominated finance. The US military guaranteed global trade routes. Technology boomed, and central banks held the majority of their reserves in dollars. But beneath the surface, cracks began to form. US debt explodes after decades of deficits. America's national debt began rising at accelerating speed. Economists waved it off, saying the US could always borrow more because the world trusted the dollar. Asia's crisis exposes the system in 1997. The Asian financial crisis devastated developing economies. Many countries blamed their downfall on exposure to the US dollar and global lenders who controlled the flow of dollars. 2008 breaks the illusion. The 2008 financial crisis shattered the myth that the dollar system was infallible. Banks collapsed. Credit markets froze. Countries saw how a crisis inside the US could instantly infect the entire global economy. And this is when central banks began doing something subtle, but deeply symbolic. They started buying more gold. A slow shift becomes a global movement for years. The change was small. A couple of tons here, a few tons there. But after 2014, the movement accelerated. Central banks from China, Russia, India, Turkey, Poland, Hungary, and many others began aggressively adding to their gold reserves. Weaponization of the dollar, the biggest catalyst, wasn't economic, it was political. The United States began using the dollar system not just as a tool of trade, but as a tool of pressure. Sanctions, banking restrictions, financial blockades. Nations realized that if your reserves are in dollars, the US can freeze them. If your trade depends on dollars, the US can stop it. Gold, however, cannot be frozen. It cannot be blocked. It cannot be erased with a keystroke. The SWIFT wake-up call. When Russian banks were removed from the SWIFT network, governments around the world took notice. They asked a chilling question. That moment triggered a historic shift. Countries began revaluating every dollar they held. America's debt reaches escape velocity. As US debt surged past levels once considered unthinkable, central banks started doubting whether the dollar would hold its long-term value. A currency backed by rapidly expanding debt is not a stable store of wealth. Gold reclaims its throne. Gold does not default. Gold does not inflate. Gold does not require trust. In a world filled with uncertainty, gold became the safe haven of last resort. Today, central banks worldwide are purchasing gold at the fastest pace in more than half a century. Some years have set all-time records. Many nations that once held almost no gold are building massive reserves. They're not just buying gold, they're dumping US treasuries to do it. 20 years ago, central banks held more than 70% of their reserves in US dollars. Today, that number is heading toward nearly half and falling year after year. This isn't a collapse. It's a controlled exit. The rise of multi-currency trade countries are increasingly settling trades in local currencies: Chinese yuan, Indian rupees, Russian rubles, and regional currency blocks. Even major oil exporters have begun accepting payments in currencies other than dollars. Even US allies are hedging. This isn't just a story about China or Russia. It includes countries like Singapore, Poland, Japan, South Korea, Saudi Arabia, Brazil, Turkey. These nations are diversifying not because they expect a collapse, but because they no longer want to be trapped if one begins. Interest rate manipulation. The U.S. Federal Reserve has used interest rates, raising and lowering them dramatically to stabilize the dollar. But this tool creates new problems. High rates threaten U.S. banks, low rates weaken the dollar. Rate swings destabilize global markets. This is not sustainable. During crises, the U.S. government prints massive amounts of new dollars. This solves immediate problems, but devalues the currency long-term. Diplomatic pressure has kept many countries within the dollar system, but alliances can shift. And history shows that financial systems don't last forever. A country gains financial dominance, the world adopts its currency, the country overspends. Debt grows beyond control, confidence cracks, nations diversify, a new system emerges. This happened to the British pound. Before that, it happened to the Dutch guilder. Before that, the Spanish real. Reserve currencies do not die suddenly. The global buildup of gold reserves mirrors previous transitions between world reserve currencies. Central banks aren't preparing for collapse, they are preparing for transition. 2. If enough nations diversify away from the dollar, the world reserve currency doesn't collapse. It simply stops being essential. Central banks aren't panicking, they're planning. The move from dollars to gold isn't emotional, it's strategic. They're protecting themselves from geopolitical risk, financial instability, and future uncertainty. The dollar is still strong, but no longer untouchable. The US dollar remains powerful. But the era of unquestioned dominance is ending. Gold has quietly become the insurance policy of nations. The shift away from the dollar won't happen in one dramatic moment. There won't be a breaking news shockwave. It will happen the same way empires fall. If you found this video eye-opening, share it. Someone else needs to see it. And if you want more deep, long-form breakdowns like this, hit the like button, subscribe, and turn on notifications.